Tyler, a lot of talk today about prices, what we pay for all sorts of stuff.
And we're paying less, it appears, for lots of things. It may not feel like that. It may feel like you're spending more, but according to the latest government numbers, you're not. Consumer prices fell 0.4% in April, slightly lower than expectations. Couple that with a report on producer prices, that's at the wholesale level, and that came out yesterday, and that showed the biggest drop in producer prices in 3 years. You got to wonder, what happened to inflation? It's one of the key things the Federal Reserve looks for, and right now, it's nowhere to be found just yet. Inflation is low, very low. So what does that mean for you? Well, obviously, it means prices are going up slowly. Gas prices were down more than 8% in April. Food prices were up, but only slightly, and other core costs, medical care, education, and clothing, showed little, if any, movement. Take out energy and food, and those core costs rose a meager 0.1% last month. For the year ending in April, they're up only 1.7%. So for now, low inflation. It's good for your wallet, right? Well, not so fast. The Federal Reserve wants inflation ideally to be rising at roughly 2% a year. That's its target. If prices aren't rising, that means demand is low. Why is demand low? Well, it means your wages are going up slowly too, if they're going up at all. And that could be a sign that overall economic growth is weak. Until the employment picture improves, wages probably won't pick up. So, should we welcome or fear low inflation and what it signals? That's what everyone wants to know.
So let's get some answers to all of that. Joining us now, Mark Zandi. He's chief economist at Moody's Analytics, and Kevin Caron, market strategist at Stifel Private Client Group. Gentlemen, thank you so much for joining us. Let me begin with you, Mark. You heard Tyler's report. So is this inflation at these levels good for us or bad for us?
I think good, Susie. I think it means more purchasing power. So, if you have to spend less to fill your gas tank, you have more to spend on everything else. So that's a big plus for the economy. And I think it gives a green light to the Federal Reserve. The Fed can continue to be aggressive with monetary policy, and that's very important to stock prices, house prices. It allows us to refinance our mortgages. So net, I think it's a plus for the economy.
Kevin, lots of people are not worried about consumer price inflation, but some investors are quite worried about asset inflation. Are you?
I'm not worried about asset price inflation in certain areas. For example, if you look at where the stock market is, you're looking at a market that's trading at a very reasonable multiple compared to underlying earnings power. There are markets such as treasuries, which you've seen yields held down, prices held up, and that is directly due in part to what the Federal Reserve is doing in terms of buying assets, effectively printing money and putting it into the system. So at any point in time, you're going to have markets that are going to be affected by Federal Reserve policy. And at some point, for example, a bond market where yields are held down too low, too long, you could have a painful reversion of that. But we don't see anything meaningful coming in that regard for quite a while.
Mark, what about you? I mean, is there a point that the stock market gets out of whack and that it would threaten financial stability and worry the Federal Reserve?
Yeah, sure. I mean, we've had a couple stock market bubbles. I mean, think back to 2000 and think back to 2007. So, yeah, there's reasons to be concerned if stock prices get too high, but I think we're a long way from that. Susie, the tried and true measure of valuations worked from the beginning of time is the price earnings multiple. That's just looking at stock prices relative to corporate earnings. And that's about 15 on the S&P 500. And that's about average since World War II. So I don't have any concern about valuation in the equity market. I think the market's appropriately valued at this point.
Well, then you agree with Kevin, basically so. So, Kevin, in this low inflation environment with relatively slow economic growth, if I'm looking at domestic stocks, where should I be putting my money?
I think you have to look for consistency, because ultimately what you're going to be looking for is a company that can perhaps deliver earnings consistently over time. When you do have a very low kind of inflationary environment, it is sometimes more difficult for companies to generate high levels of earnings growth. So therefore, I'd be willing to pay a premium for consistency over, for example, very rapid growth. So stable balance sheet, very good liquidity on the balance sheet, consistent earnings, maybe a little bit of a dividend. I think all of those things make sense.
Mark, let me ask you about another word that we haven't heard in a long time, deflation. This is falling prices, just the opposite of inflation. Do we need to worry about that? Could that creep into the economy?
Well, it's always a risk, but no, I'm not concerned about it. I mean, for that to happen, we'd have to go back into a full-blown economic recession with the falling employment, rising unemployment, which, you know, you can't rule out. There's a lot of risk out there, but I think the probabilities of that are very low. And the other thing to consider is that inflation expectations, they're rock solid, and they're right about where the Fed wants them to be, about 2%. So that's a good sign that deflation is not a significant risk, at least not at this point.
Kevin, I get two questions for the price of one here. What kinds or categories of stocks do you find have the attributes that you just described as the kinds of places where you want to put your money? That's question one. And question two, one of the Federal Reserve governors or bank presidents, I can't remember which, out in San Francisco today said that potentially the Fed might pull back on its bond purchases as early as this summer, given economic conditions. Does that alarm you?
Well, I'll take the first question. I think that if you're looking for stability and consistency, you can find that in places like consumer staples, maybe a little bit rich right now, but on a pullback, I'd be interested there. Healthcare, I think, has some interesting attributes to it. I think if you look at technology, technology has underperformed the last year or so, very good balance sheets. There's opportunity there. I'm not particularly concerned about the Fed pulling back in terms of their asset purchases. In fact, if anything, I would expect to see them doing more, because when you look around the world, what do you have? You have a stronger dollar recently. You have inflation expectations priced into the bond market looking out maybe 10 years coming down somewhat. You do have a relatively soft underlying inflation. And with other nations around the world engaging in asset purchases now in a significant way, for example, Japan, their recent announcement of asset purchases and the stepped up program, that actually would encourage the Fed to do more, not less.
All right, gentlemen, thank you so much for coming on the program. We really appreciate it. Mark Zandi of Moody's Analytics, Kevin Caron at the Stifel Private Client Group.